So I want you to take a trip with me as I use the techniques illustrated in AIM to invest in the stock market, particularly in index funds. And you can track with me my progress as we go through it. All right, let's go. Hello. I want to talk today about the automatic investment management system created by Robert Lucillo. And to introduce this, I just want to start off with a little story. Once upon a time, two close friends, Jay and Ray, found themselves engaged in a conversation about investing in stocks. Ray was an avid investor, was excited to share his knowledge about a program he recently discovered called AIM. He had read a book on AIM by Robert Lucillo and believed it was the key to successful stock market investing. Curious and always up for an adventure, Jason listened intently as Ray explained the principles of AIM. The technique involved a systematic approach to investing, using a combination of asset allocation and market timing to ensure maximum gains and minimize the risk for investing. Jay's sharp mind quickly grasped the core concept, and he decided to give it a try. Weeks passed, and Jay diligently applied the AIM strategy to his investments. With time, his portfolio began to flourish, and he saw significant gains. As his wealth grew, he couldn't help but feel a sense of gratitude towards Ray for introducing him to this transformative technique. When it comes to investing in the stock market, we've all heard the classic advice: buy low, sell high. It is the golden rule of investing, encouraging us to purchase a stock at that low price and sell it later at a higher price, and thus making that profit. However, despite this well-known wisdom, many investors seem to do the exact opposite. They buy high and sell low, leading to losses instead of gains. This phenomenon is likely driven by emotions, influencing their decisions. When faced with the downturn in their investments, fear of further losses clashes with the logical notion of selling at a high. This behavior is especially common among average retail investors who might lack sufficient experience in tracking market trends. As a result, their emotions tend to outweigh the common sense approach of selling when the price is high. To challenge the notion faced by retail investors, they need an algorithm that can provide recommendations on whether to buy, sell, or hold a stock. Furthermore, the algorithm should indicate the appropriate amount of stock to buy or sell. One such algorithm, the Automatic Investment Management System, or AIM, presented by Robert Lucillo in his book, How to Make $1 Million in the Stock Market Automatically, manages an investor's portfolio by guiding them on when and how much stock to buy or sell. However, AIM does not handle the initial evaluation of a business's value, leaving the responsibility to the investor. I plan throughout these videos to explain the implementation details of the AIM algorithm and additionally explore potential modifications to the AIM system that may lead to an improved performance. With such tools in hand, a retail investor can make more informed decisions and navigate the stock market with greater confidence. Implementing AIM is relatively simple and straightforward and can be done with a paper and a pencil. To calculate the advice or buying or selling a certain number of shares of stock in the traditional AIM system, the investor only needs to track a few variables: the invested amount and the current stock prices. Now you need to determine when you're going to reevaluate your portfolio, manage it. You can do this yearly, daily, weekly, bi-weekly, monthly, is however you want to do it. I found that the more frequent allows you to take up more opportunities. However, you might, with the daily, I've seen that, what I call it the local minima. So if you're buying stock and you capture these local minima, you'll buy and spend up all your cash reserves before it actually hits the bottom of the market. But overall, I found that the returns are slightly better by doing daily calculations on this from backtesting, which I will go through also. See the importance of picking out the correct stock for investing. So let's take a look at some of the stocks that I'm going to look at, which are AIM has certain limitations that need to be recognized. It cannot guarantee profits by selecting the stock for the investor. The success of the strategy depends solely on the investor's actions. Through backtesting of various securities with the AIM algorithm, I have identified several desirable properties for successful implementation. One, we need volatility. Volatility allows buying at low points and then selling at higher points. So if the stock just remained the same all the way across for year after year after year, it wouldn't help. Safety also ensuring that the security doesn't plummet to zero, causing the investor to lose everything. So we need volatility and we need safety. By looking at these two variables, these variables, suggest that we want to probably use an index fund, such as a group of individual stocks that might be suitable for the AIM implementation. And if you need an example to illustrate the importance of proper security selection, consider the following example. The first example I'm going to talk about depicts an AIM strategy implemented on a failing company like Radio Shack, while the second example shows the AIM operating on SPY for the same period, or SPY, which is an index fund of the S&P 500 stocks. And then if we compare those two examples, really highlights that danger of choosing a security that is not safe, that may ultimately fail. Additionally, it's essential to observe the underutilization of cash in the second example, as with the S&P 500. The example of investing in Radio Shack illustrates the potential danger of selecting a single company for a portfolio. AIM has no mechanism to understand that the company is actually failing versus a discount on that share price relative to its actual value. So we get lots of buy signals as Radio Shack fails, starting through 2006 all the way through 2015. That said, this portfolio that we're looking at for the S&P 500 may generate a higher return if the investor chooses an index that has more volatility, such as a sector-specific index or index that uses leverage. Those other types of index funds will be also explored through other videos, and their frequency, and we'll also explore the frequency of updating the portfolio in other examples as well.